Every dollar in a bank account is mathematically identical, yet the human brain treats them as completely different currencies based on where they came from. This psychological phenomenon, known as mental accounting, explains why someone might meticulously clip coupons to save 50 cents on groceries while simultaneously overspending hundreds on a vacation, because it feels like a separate budget. By understanding the mechanics of these invisible mental buckets, it becomes possible to identify why rational people make irrational financial choices and how to fix the internal logic that drains net worth over time. The concept of mental accounting was pioneered by Nobel Prize-winning economist Richard Thaler in the late 1980s to describe how people categorize and evaluate economic outcomes. In standard economic theory, money is considered fungible, meaning every dollar is interchangeable regardless of its source or intended use, but the human mind rarely follows this rule. Instead, individuals create internal accounts for specific purposes, such as a grocery fund, a vacation fund, or a rainy day fund, and assign different levels of spending permission to each. A famous study illustrated this when people were asked about losing a $10 theater ticket versus losing a $10 bill. Those who lost the bill were far more likely to still buy the ticket. Even though the net loss of $10 is the same in both scenarios, the brain views the lost ticket as a loss from the entertainment account, making a second purchase feel like an unacceptable double expense. But here's where it gets interesting. The source of capital dictates how it is spent, and nothing proves this more than the average American tax refund, which recently hovered around $2,800. When money is earned through a traditional salary, it is often categorized as hard-earned income and spent with caution on necessities like housing and insurance. However, when that same amount of money arrives as a windfall, such as a bonus, a gift, or a tax refund, the brain often labels it as free money or a win, leading to significantly higher luxury spending. Studies from the Journal of Behavioral Decision-Making show that people are nearly 20% more likely to spend money on frivolous items if that money is perceived as a gain rather than a return of principal. This is often referred to as the house money effect, a term borrowed from casinos where gamblers treat their winnings with less care than the original stake they brought from home. By failing to realize that a $3,000 refund is simply an interest-free loan given to the government, taxpayers often squander capital that could have been used to pay down high-interest debt. The data tells a different story regarding how payment methods change this even further. Mental accounting isn't just about where money comes from, but also the physical or digital medium used to transfer it. Research from MIT has demonstrated that consumers are often willing to pay up to 100% more for the same item when using a credit card versus using physical cash. This is due to the pain of paying, a psychological friction that occurs when someone physically hands over a $20 bill and sees their resources diminish in real time. Digital transactions decouple the pleasure of the purchase from the pain of the payment, effectively moving the cost into a future mental account that feels less real in the present moment. Retailers capitalize on this by encouraging one-click ordering and digital wallets, which minimize the mental accounting checkpoints that might otherwise stop an impulsive purchase. When the friction is removed, the brain stops treating the digital balance as real currency, leading to an average spending increase of 12 to 18% across most consumer categories. But the most dangerous trap involves how people handle money already spent. To combat the mental accounting trap, one must adopt a unified view of their financial landscape where every dollar is treated with the same level of scrutiny. One effective strategy is the overnight test, which involves asking if someone would still spend a windfall on a specific item if that money had been sitting in their primary savings account for 6 months. Financial experts often suggest moving all extra income, like bonuses or tax refunds, directly into an investment or debt repayment account before the brain has a chance to label it as fun money. Another powerful technique is to calculate the cost of items in hours worked rather than dollars, which forces the brain to move the purchase from a secondary mental account back into the primary income account. By breaking down the invisible walls between these mental buckets, individuals can ensure that their capital is working toward long-term goals rather than being siphoned off by short-term psychological biases. The final step is recognizing that a dollar saved from a coupon is mathematically identical to a dollar earned from a side hustle or a dollar found on the sidewalk. The most important takeaway is that money has no memory of where it came from, and treating every dollar as a tool for net worth growth is the key to avoiding common cognitive traps. If this changed how you think about mental buckets, the next video breaks down how the sunk cost fallacy keeps people stuck in losing investments.